because this is one of the forms that we are that we're going to be using in this chapter. We're using a couple of different forms, actually several forms. 4797 pertains to the sale of business property. All right. And you'll see there are several different sections to this. So the ordinary gains and losses, this is kind of the section we're going to be looking at first, because this is ordinary income. These are ordinary income assets. Part 1, sales or exchanges of property used in a trade or business, involuntary conversions from other than casualty or theft, held more than 1 year. Okay, so we're going to make a distinction. We've got to make a distinction as well for these, for the business property, between whether it was held for less than 1 year or more than 1 year. Gain from property, from disposition of property under specific code sections. Now you'll notice 2 of the code sections that we talked about, that the chapter mentioned, 1245 and 1250 property. There is a section specifically dedicated to that type of property, as well as a few other types of property. We're not going to worry about these other types of property. We're just looking at 1245 and 1250 property. So we're going to have to use this section as well when we do some of our calculations. So this is the form 4797. Again, this only pertains to sales of business property. So this is the form that's going to be used when we're talking about ordinary income property and the business, what is it, 12, see, I can't even keep the numbers straight. The 1231 business assets, okay? Again, we have to make a distinction between these two. Ordinary income property, generally speaking, is if we're selling inventory, we're selling accounts receivable. Anything that, if it were sold in the ordinary course of business, would generate ordinary income for us. As opposed to 1231 business assets, these are assets used in the business. So tractors, trucks, furniture, computers, other types of equipment. Okay, so, but think about your balance sheet and the items that your balance sheet has on it. It lists inventory and it lists accounts receivable on the balance sheet. So when we sell those items, but this is outside of the normal course of business, those are still considered to be assets, and they have some special treatment in the tax code. All right. Let's see, what do I want to say here? So again, first thing we need to know in order to calculate any gains and losses is the basis of this property that we're going to sell, right? We talked about that extensively in the last chapter. We've got our beginning basis. So whatever the cost is when we purchased it, plus all of the costs of getting it ready for sale, right? So we've got our beginning basis. We would add to that the cost of any improvements, right, that we have made. Any other types of, or additions, things of that nature. We would reduce it by depreciation to arrive at our adjusted basis. This is the number that we're going to have to use in our calculations of gain or loss. So let's just kind of do an example. Let's say we had a piece of equipment that we purchased, and we purchased it for $20,000. That one doesn't work at all. $20,000. We owned it for a few years, and then we decided we wanted to add an additional piece to it to improve it, to make it, increase its efficiency, or it's going to extend its life somehow. So we had some improvements, $5,000 a few years ago. And then we've taken depreciation on this piece of equipment of $7,000 using the calculations we did in the last chapter. Our adjusted basis for this piece of equipment is now $18,000. If we sell the piece of equipment for 20, we're going to subtract the 18. We come out $2,000 ahead, right? This is a gain of $2,000. Depending on what this property is, what classification it falls under is going to determine how we treat this gain. Okay? Let's say we sell it for, instead of $20,000, we sell it for $15,000. Well, now instead of a gain, we're still going to subtract this $18,000 from it. Now we have a loss of $3,000. Again, how we treat that loss is going to depend on what type of asset it is, what its classification is. Okay, so this is why we have to start with that basis, but then we increase it by improvements, decrease it by depreciation to arrive at our adjusted basis. Okay, which your book talks about here. Cost basis is adjusted for certain items such as improvements, increased basis, depreciation deductions, which decrease basis. Let's highlight them, shall we? And then they've given an example here. So, as I mentioned here, the concept of adjusted basis is important. This basis will be used to determine the amount of the gain or loss on the sale or the disposition of that property, which we just illustrated. The lower the adjusted basis, the greater the potential gain. You can see that. So the lower, if this basis, let's say we took $8,000 of depreciation instead of 7, well, that makes this 17, right? 17,000. We sell it for 15. Now our loss, 17,000. Now our loss is only $2,000. Essentially what happened is that $1,000 loss that we would have taken when we sold it, we already took it up here in the depreciation. That's where we got the tax benefit, up there. Essentially it's just shifting from here up to here. Same thing if it were a gain. So let's say it's 17,000, oh, it's still 17, and we sell it for 20. Well, now instead of, what did we have before? We had a $2,000 gain. Now we've got a $3,000 gain. On that asset. So that's what they mean when they talk about the fact that the lower the adjusted basis, the higher the gain will be, or the lower the loss will be. Because essentially you already got that benefit when you adjusted that basis downward with the depreciation. Okay. Conversely, the higher the adjusted basis, the lower the gain and the higher the loss. Okay. Now, it's really simple when we purchase the asset, figuring out what that basis is. But as we sort of saw in the last chapter, when we obtain that asset in some other way, like through inheritance or through an exchange or through a gift, the basis, it's a little bit trickier to figure out what that basis might be. So if the taxpayer receives investment property in exchange for services, okay, so now we're not buying, we're not getting it through inheritance, we're not getting it through gift. We're still sort of purchasing it, but we're not purchasing it with cash. We're purchasing it with our services. Example, I'm a CPA and I need a new desk. Okay, I need a new desk for my office. I know somebody who makes some really nice custom desks, usually charges $1,000 for those desks. I really like them, I really want one. I offer to prepare taxes in exchange for that desk. So if I'm obtaining an asset, but I'm not actually paying cash for it. I'm paying for it with my services. So what happens in that case? The basis of the asset is the fair market value of the property. So the fair market value of that desk is $1,000. That's what they ordinarily sell it for. I'm going to give the equivalent $1,000 worth of services. The basis is going to be the $1,000. Okay. If the value of the services was known beforehand, then the assets basis would be based on the price of the services. So if I'm just saying, hey, I want that desk, I'll prepare your tax return. I don't know how much it would have been, what I would have charged for it. Then it's going to be the value of the desk. If I instead say, I'm going to give you $1,000 worth of services in exchange, maybe I'm going to give you, I charge $100 an hour and I'm going to give you 10 hours worth of work. Now I know how much the value of those services are. The desk is worth $1,000 based on the services. So it all depends on whether you know what the fair market value of the services are. Okay, let's see. Okay, so that's if we're exchanging services. Now we also want to talk about if we inherit property. So for example, let's say I inherited a building from my grandfather. He bought it for $20,000 back in 1970, and the building is now worth $500,000. Okay, and then I turn around, and then he passes away when it's worth $500,000, and I inherit it. The value of my basis of that property is going to be the fair market value of it on his date of death. So, which is really great, because if Grandpa had sold it for $500,000, remember his basis was $20,000. If he sold it for $500,000, he'd have a $480,000 gain. But if I inherit it and then I turn around and sell it, my basis is $500,000. I sell it for $500,000. There's no gain and no loss. So we've just managed to avoid tax on $480,000 worth of income. Okay, so it's generally valued at the fair market value of the property on the individual's date of death. Now there is an alternative valuation method. We're not going to get into that. Let's see. So this really, for our purposes, just remember this fair market value on the date of death. Okay. Let's see. They go on to talk about the spouses. So what about a gift? Okay, so Grandpa, instead of waiting until he passes away and I inherit that property, he instead just gives it to me. Well, that's not as good a deal as if I were to inherit it. Rules for assets transferred by gift depend on, now you got to do some work, whether the fair market value is less than, equal to, or more than the donor's adjusted basis. Okay, so let's go back to our home, or our building that we inherited. Sorry, we didn't inherit it, I inherited it. so now we've got to do kind of a comparison here. So if our fair market value is 500,000, like this one either. No. All right. But my grandfather's adjusted basis, we'll say it was just a personal property, but I'm going to use it for business. So he wouldn't have depreciated it, right? So the basis, I'll put adjusted here, is 20,000. All right, so we've got to compare those two things. If the fair market value of the property at the time of the gift is less than the donor's adjusted basis before the gift, the donee's basis for a gain on the sale or other disposition is the donor's adjusted basis. So that basis becomes the new basis for the individual who is receiving it. Okay? So the basis for a loss, so if it's a loss, that's if it's a gain. The basis for a loss, the fair market value of the property at the time that the gift was given. All right, so if it's a loss, this is going to be our fair market value. If the fair market value is equal to or greater than the donor's adjusted basis, which it is in our case, then the donor's adjusted basis, the donee's basis for calculating a gain or loss is the donor's adjusted basis. So, Grandpa gives us this property. His basis is $20,000. Fair market value is $500,000. If we turn around and sell this property after he's given it to us, we get his basis. So now that $480,000 is taxable, and we're going to have to pay tax on that as income because it was gifted rather than inherited. Let's see. Yeah. Let's say the opposite is true. So the fair.
You don't pay tax on the 20,000 if you sold it for 480.
So if you sell it, right? So if it's gifted to you, you get their basis, right? You because the fair market value is higher than the basis transfers over to the new owner. If they sell it, their gain or loss is going to be based on that basis. Okay, so let's look at it from a different perspective. Let's say our fair market value was still 500,000. Okay, but our adjusted basis, maybe it's decreased in value somehow, or something happened to it. It's just been let go, and so it's actually decreased in value. So here, the fair market value of the property at the time of the gift is less than the donor's adjusted basis. Then the donee's basis for a gain on the sale is the donor's adjusted basis. So if we have a gain, this is our adjusted basis. If we have a loss, this is our adjusted basis. So essentially what that does is it decreases gains, but it also decreases losses. So if we end up selling it for $550,000, we have a gain, so we're going to use $520 as our adjusted basis. This is our $30,000 gain here. Now, if we sell it for $450,000, now we've got a loss. So our adjusted basis now becomes the $500,000, and we have a loss of $50,000. So that basis changes. Which basis we use changes depending on whether it's a gain or loss, but that's only if the adjusted basis is greater than the fair market value. If it's the other way around, then you just use the adjusted basis. Okay? That's if it's transferred by gift. Inheritance was a lot easier, wasn't it? So here's some definitions that they give you here. Basis, we should know what basis means. And then how we figure out the cost. Let's see. Cost basis, other cost basis. Adjusted basis, increases or decreases. You know, increases for improvements, decreases for depreciation. Also 179 deductions, special deductions. I'm sorry, the special depreciation as well. And then the fair market value, how do we define that? That's the price that a willing buyer and seller would come to an agreement. Sometimes you need an appraisal in those cases. So here we go, amount realized again. So remember, we've got a difference between realized and recognized. We're going back to that. Amounts realized are the actual cash that you received it for. What did you sell it for? So in this case, $550,000 would be the amount that we realized. We're getting $550,000. $450,000 in this scenario. This is not, though, what we recognize for tax purposes. What we recognize is going to be the gain or the loss after we make that adjustment for the basis, right? Anytime you have an amount realized that is more than the basis, the adjusted basis, you're going to have a gain. If you have an amount realized that's less than the basis, you're going to have a loss. All right. So, some examples. We've got Indra sold a parcel of land for $55,000 cash. Oh, I guess I skipped over something because this goes into detail about notes attached to the land. So it's not just it might not be just cash that is exchanged in these transactions. So we talked about services being exchanged and said, but also any liabilities that are attached to the property might also be transferred. By liabilities, I mean, in the case of a building, a mortgage. So if we've got say we've got a building that has, so it's worth $500,000, but we have a mortgage on it of $200,000, so we're still paying on that mortgage, right? So essentially our equity in this building is $300,000. That's a liability, so that's the liability attached, what we're referring to. There's some sort of debt that's still attached to that particular asset. So sometimes what happens is when in those transactions, it's rare, but it happens occasionally, that debt will then become the responsibility of the new owner. Okay, so they're taking on that debt themselves. Okay, so what happens in those cases, in that case, so let's look at this example to kind of show you. So we got Indra sold a parcel of land for $55,000 of cash. The buyer also assumed a $15,000 note that was attached to the land. Indra originally purchased the land for $34,000. So the gain on the land is $36,000. Now, how did we get that? We're going to take the $55,000 of cash received plus $15,000 release of liability, because that's now $15,000 less that individual has to pay out, right? They would have had to pay on that liability. less the $34,000 basis. Okay, so any release of liability, we're going to add to the cash that's received. Okay, so this is we've got $500,000 for our basis, $200,000 of mortgage. Let's say we received cash of $600,000 for this property. We're going to add that $200,000 onto it for purposes of figuring out our gain or loss, because we're released from that liability. So now essentially what we got was $800,000. We'll say that the basis, well, that's the mortgage. We'll say that our basis is the same as the mortgage. So if this is our adjusted basis, now we've got a gain of $500,000. Because what we received was $600,000 plus now we don't have to pay that debt. Okay, so the release of liability less our adjusted basis. Let's see if there's anything else I want to say here. So essentially that $200,000 release is an additional amount that's being realized by us. We now don't have to pay it. Okay. Questions? This is just the basics of gain and loss, adjusted basis, and that sort of stuff. We're going to get into the details of different types of property in just a second. Questions?